Other questions, send us an email at any time. Support@powerop.com, support@radioactivetrading.com. Call us during market hours at 302-992-7971. Trial members and subscribers schedule a free coaching session. Now, I'm going to go back to power options real quick. I did have a last-minute question that came in, and I don't know how, if you were with us for the whole presentation or any of the presentation there. Hold on 1 second. Try to undock this. There we go. Wallace says, what options are there besides covered calls to protect the downside on earnings? We just spent an hour showing you the best way to protect stock positions that you own, to protect positions going through earnings. It's the Mary Put approach. I'm going into earnings. I don't know what's going to happen. I have a stock. If I have a gain in the stock, Wallace, I'm going direct. If I have an unrealized gain in the stock going into earnings in the next couple of weeks, I'm going right into the insurance tool. Not the real situation. I'm going to take Kraft Heinz, not the best example. I'm going to take Kraft Heinz. You know, I mean, it's about 29 something. Let's say I bought Kraft Heinz a few months ago at $26, and I know earnings are coming up in the next couple of weeks. Let me see. What if I go out to July? What if I got here? Shows me right here I have an unrealized profit of 13.3%, and going out to July with a stock at $29.46, a 30 strike put, I have a locked-in profit of 7.5%, guaranteed bulletproof status going through earnings. 9.8% at the 32.5 strike, which is ironically the put that I have, but it's out to January. What do I mean by bulletproof? I own the stock at $26. I'm going to pay $136 for this July 30 strike put. Oops, sorry, folks. Which means what? I'm going to add to my cost basis of the overall position. I'm going to take it up to $27.89. Okay, well, at midpoint is $190, so let's call it $27.90. But I bought the 30 strike put, guaranteed to get $30 back or $3,000 back. I've guaranteed a profit to the downside of 2.5% and left my upside open going into earnings. Guaranteed profit, can't lose more. That's if you have a gain on the stock. Well, if I have a stock that's declined in price, I still might want to add a put to what? If the stock drops 30% in earnings, buying that put now can cap your losses at maybe at the 7, 8, 9, 10% that you have right now. Of course, if you have a 20, 30% loss, buying the put might lock you into that 30% loss. But if the stock falls a surprising other 15 to 25% loss, you've sort of protected yourself against that as well. Premium is good, but remember, premium as protection only gives you enough protection as the premium you collected. In a covered call, I might collect 3 or 4% premium, maybe on a higher volatile stock, 5 or 6%. Still means I'm risking 94% of what I invested in the position. Another approach you might want to consider, combining the two, not as long-term as the Mary Put we discussed that we use, or you can use that insurance tool that we talked about going through earnings. Long collar is the combination of the two, right? So in a long collar position, I'm going to sell the call that caps the upside, which I hate doing around earnings because I've been caught with that too many darn times, Wallace. I've given up some profits even on my married puts where I saw a way to bulletproof before earnings by selling the call, and it had a 29% gap that I've never seen in the stock before. Goose Holdings is one of those in my track record that did that to me. I got a 9% profit on Goose Holdings. Stock was up 29%. I didn't make that because I sold the call going into earnings. I was bulletproof before earnings, but I capped the upside. But a collar position combining the two. Keep the protection, limit the downside to 2, 3, or 4%, buying a 1 month out, maybe out of the money put around earnings, and selling a call against it. Of course, if you're expecting wild swings, on your stock, some people will buy a straddle or buy a strangle, meaning that let's go to the custom spread tool again. And I'm not going to use a gain in the position. Let's just take, we talked about BABA recently. Okay, let's just take the current stock price. We know the earnings are coming up, Wallace, on May 13th. So let's say that I own the stock, not at 142, but I just buy it today, doing an earnings play, and I bought 100 shares of it. Probably wouldn't do this as an earnings play, okay? But I own the stock, not at 100. I own it at 109. I know earnings are coming up. So what I might do for that May 16th expiration, buy a 110 call and buy a 110 put. Why would I do this? I'm adding a strangle, which by its a straddle, excuse me. I didn't add the stock. I'm sorry. I did that wrong. Let's do that. Sorry, folks. There you go, 530. So now essentially I did a married put and I added to the cost basis. This isn't what I really wanted. What I really want to do is this. You saw it earlier when we talked about income method number 12. We briefly glossed over this for Guillermo. I could buy the put as you saw to protect the downside. If I buy two puts, but I'm paying a high price there, $13, you create a synthetic straddle with a stock investment. Lower break even of 97.90, upper break even of 122.10. The problem is that you've added an additional $1,300 to the risk in this trade if the stock stays right where it is through May expiration. But potential to win on the downside if there's an unexpected large drop on the earnings. Still potential for unlimited upside profit. You just need a wider move up to that 122 strike and beyond. Okay? So that's an idea. Buying two puts against your security short term, right at the money, you create a synthetic straddle going into earnings, but you've got to be aware of what we call no man's land, Death Valley. The stock only moves to 105 or here, where I would only have maybe a $3 or $4 loss on the position. You're looking at double that because the put value hasn't taken over and the call value is going to zero. Same thing here. It goes up to 115. It's 7 points, 8 points, 7 or 8% move. Okay, 6 or 5% move. I'm at an $800 loss, where originally, 109, I'd be at a $5 gain. Okay. To protect downside in earnings, it involves buying a put. Whether you want to do that in the standard collar form, whether you want to do it in a married put form, whether you want to do it in our preferred married put approach, or use just a shorter term put for quick earnings, that's the way you protect the downside. Bear put debit spread, a way to pay less to do it. Yeah, you can do that too. But remember, in it, the debit spread has a capped gain, a capped profit to the downside. So if you get the 5 points on the bear put debit spread, but the stock dropped 25 points from a surprise earnings, you're still out a fair amount. You hedged a little bit, but not more than the profit on the debit spread for an unexpected continued decline downwards. All right, so I might get back to you on that a little bit later on, Wallace. There's some webinars we have where discuss that. Protection in markets, not necessarily protection in earnings, but protection in market. And there is a full playlist on our YouTube channel, by the way. Let me go back. Let's go to our YouTube channel. If you go to our YouTube channel, you go to the playlists, you see a variety of different discussions here. Debit spreads, collar trades. Here's one on earnings discussions. But you can view the full playlist there, and it goes through different earnings discussions that are available, different ways to protection, but also the one I'm looking for is we did a comparison on SPY. I think that's the link I'm going to send you. It's different. The comparison on SPY goes through protecting for downturns, just buying a put, buying calls on the VIX, doing a bear put debit spread, doing other hedge techniques like ratio spreads. Which one works out better? Well, it does depend on the movement in that case as well, Wallace. So you got to pay attention to that too, based on your expectations.